lot of these large portfolios had values put on them, and
Right.
it strikes me that a lot of the valuations were disseminated more widely than they should have been based on limited data and limited models through daisy chains of markets or market quotations.
I mean, it's a fascinating question. Actually, I'm writing something in the New Yorker at the moment about the efficient market hypothesis because I've just been out to Chicago to talk to the sort of high priests a year after, and see, including Gene Famer, who was the founder of efficient markets. I'm pretty critical of it, to be honest. I think there's two versions of the efficient markets hypothesis. One, I'm willing to go along with, that it's difficult to beat the market. The market is efficient enough to make it difficult for an individual or a firm to beat the market. I think there's 30 years of research showing that. There are some sort of anomalies which you can exploit from time to time, but the market's efficient enough that once one person learns them, somebody else learns and it gets eliminated pretty quickly. So if that's what the efficient market hypothesis is, you can sign me up, I agree. But the idea that markets never depart from economic fundamentals and that the market price is always right in some sense, I think has been completely discredited by what we've seen. These credit products were chronically mispriced for years. 50 basis points above treasuries, they should have been trading at, 1,500 basis points above treasuries or something. That was, it seems to me, now, Gene Famer and people have got a very convoluted argument for why the market wasn't failing, which I'm trying to sort of convert into English to, if you keep reading the New Yorker, you should get a version of it. But it seems to me, it's a bit like when Hubble discovered that the universe was expanding. There were some guys who said, well, actually, he's got the results wrong. And, if you reinterpret these results, the universe is actually still stable, which Einstein believed. I think, that's all nonsense. This was clearly an example of chronic inefficiency in the capital markets for years on end. And we had another example of that 10 years ago in the stock market. We probably had an example of it in the commodities market last year. Financial markets are prone to speculative bubbles. And that seems to me to be fundamentally, they're not always, but they're periodically they're prone to it, and that seems to me to be very difficult to reconcile with the efficient markets hypothesis.